All right, Marcus here, and I need you to lock in for the next few minutes because gold and silver aren't acting like steady hedges right now. They're acting like stress instruments. As I record this, spot gold is around $5,156 per ounce, and spot silver is around 89.5 per ounce on Kitco, and implied volatility isn't calm. CME's CVOL is roughly 37 for gold and 96 for silver. That combination matters more than the daily candle, because if you own metals for safety, the real question is, safety from what? Price or system? Not a meme, not a rumor, not just a chart move. If this isn't speculation, what is it? Here's the balance sheet version. When metals whip around like this, it's rarely just sentiment. It's usually positioning plus funding, and those are balance sheet variables. Simple example. If you have $10,000 in a metal ETF and the market drops 5% in a fast liquidation window, that's a $500 drawdown before you even think about spreads, tracking, or whether you can actually convert exposure into control when everyone else wants out. In stress, the price is secondary, the plumbing is primary. By the end of this video, you're going to understand what this move signals under the hood, why the headlines miss it, and how to position structurally, without trade calls and without price targets. Most people miss this next part. And before we're done, I'm going to answer 3 questions I want you to hold in your head right now. What's happening to liquidity and funding? Do you actually own something, or do you just have exposure? If this keeps tightening, what breaks next? Don't answer yet, just hold them. To understand the crash narrative, you need to see the market in 2 layers. Layer 1 is financial exposure, futures, options, ETFs, swaps, margin, leverage, paper claims. This layer is liquid until it isn't. It's fast until spreads gap. It's convenient until funding costs bite. Layer 2 is settlement reality, custody, allocated versus unallocated, deliverable supply, inventory, delivery mechanics. In calm markets, these layers appear aligned. In stress, they can separate. And here's the critical point. This isn't a flaw. This is the design. The system is built to net exposures efficiently most of the time, but when volatility jumps and funding tightens, participants stop thinking like investors and start thinking like risk managers. That's when paper becomes expensive. That's when exposure can trade like a trap, and that's why a sharp drop can happen even when the long-term reason you own metals hasn't changed. Let's build the chain cleanly. When real yields stay elevated, holding non-yielding assets becomes more expensive at the margin. Fred shows the 10-year TIPS real yield around 1.74% on the latest available reading. That's not a prediction, that's a cost of carry reality. When carry is costly and volatility rises, the first thing that happens is simple. Risk desks reduce gross exposure, not because they hate gold, because they hate uncertainty plus funding cost. When dealers sense one-way flow, they widen spreads and reduce balance sheet commitment. That's normal, and it's one reason retail investors feel like the market slipped during fast sell-offs. As the trade moves from idea to risk, everyone asks one question. If I need to exit, who is taking the other side? And on what terms? That's when the market starts to test the difference between exposure and settlement. And that's exactly what we're seeing in the options market. Gold's implied volatility is elevated, with CME gold CVOL around 37. Silver's is dramatically higher, with CME silver CVOL around 96. Silver is the thinner, more reflexive instrument. When stress hits, silver often moves like a leveraged version of the same theme, because structurally it is. Not panic, not rumor, not Twitter. This is how funding conditions express themselves through positioning. If you think this is just a price move, you're missing what it signals for the rest of the system. We've seen this dynamic before. A so-called safe asset sells off with risk assets, not because it's suddenly unsafe, but because it's being used as collateral, as liquidity, as a source of funds. When balance sheets tighten, the market doesn't sell what it hates, it sells what it can. And metals, especially through paper exposure, are often in that can category. That's why you can get a sharp drawdown that looks like the story is over, right before the next phase begins. Because the real story is rarely the headline. It's the funding. The lesson wasn't learned, it was postponed. So here's how you position. 3 asymmetric principles. Increase liquidity control. You want your personal balance sheet to handle gaps. That means cash buffers, short-term flexibility, and avoiding forced seller math. Reduce counterparty distance. If you're using products that add layers, brokers, custodians, fund structures, understand what you really own and what you're owed. Counterparty distance is invisible until it isn't. Preserve optionality over leverage. Optionality means you can wait, act, or do nothing without being forced. Leverage removes optionality precisely when you need it most. No trade calls, no targets, just structure. Here are the kinds of indicators that tend to show this is getting less stable, not more. Implied volatility staying elevated in metals options. Real yields remaining elevated, keeping carry pressure on. More frequent intraday whipsaws instead of orderly trends. Wider spreads or worse fills during fast retail executions. More gap risk around macro headlines and policy communications. These aren't healthy system signals. Treat this like weekly maintenance. Reduce concentration risk. Fix duration or time lock risk. Improve custody and control. Strengthen structural diversification. This is not a trade, this is insurance. Now remember the question about liquidity and funding? When real yields are elevated and volatility rises, funding becomes a governor on risk. That's why sharp drops can feel disconnected from the long-term thesis. Now remember the question about ownership versus exposure. In calm markets, exposure behaves like ownership. In stress, exposure behaves like a claim inside a system that reprices risk, widens spreads, and prioritizes settlement mechanics. Convenience is not the same as control. And what breaks next? Usually it's not the thing on the screen. It's the over-levered participant, the forced hedger, the dealer balance sheet that steps back, the strategy that assumed liquidity would always be there. So answer this in the comments. A. Liquidity-driven correction. Settlement-driven stress. Follow and subscribe if you want more structured macro analysis without hype. Share this with someone who still thinks metals only move on headlines. This is education, not financial advice. The only question is whether you act while exits are open. Stay sharp, stay informed, stay ahead.